Nssf. And it's interesting because this is not a new act. It's an act that was enacted more than 10 years ago. But the implications are far-reaching. To some, they think they're positive. Some people are a bit skeptical. But the fact is, this is something good. From my perspective, I believe it is something good. So I'll try to focus not more on the governance issue of the act, but I'll try to look at, for you as my client and for you as my listener, what are some of the things that will directly impact you? So I'll try to make this more of a conversation as opposed to having to deal a lot with presentations. At one point, I will project some screens, but most of it will be more of observations and discussions. And I would be glad to hear, to see you participate, and let me know if you have questions or if there's something that you'd want me to focus on. So to start with, the act is called Nssf Act 2013, because that is when it was assented to. It was assented into law in December 24th, 2013. That means it has been deferred for more than 10 years, a whole decade. So the act was supposed to be implemented from January 2014, but employers and many other stakeholders said they need more time. So they were given 6 months, but by the end of the 6 months, some people went to court and the implementation was suspended indefinitely. And definitely there are implementation challenges. Many people felt like it was assented to so soon and the implementation needed to be done within 6 months. Most organizations had already worked on their budgets. They didn't have extra money to put into this. And so I believe there was given that room for people to deliberate and to prepare for it. However, while I really want to be sympathetic with employers, because the employers seem to be the ones who are feeling it the hardest, the thing is, I don't know if 2013 was likely a better time than now. I think now we are having many economic issues to deal with. We are just coming from COVID. We are dealing with high inflation rates. We are dealing with, I mean, everything seems to be out of control. When I try to think of how 2013 was, I think it was probably a better situation than now. But the one thing we all agree is that there is never a good time. If you're not dealing with COVID, we'll be dealing with inflation. It is post-election violence. It is election. There is always something that always happens that makes it difficult to add additional costs. So I believe that even if the implementation of this act is delayed, there will never be a perfect time. So I believe we need to trust God that He will provide the resources that we need and actually go ahead and implement this act. I believe most of you have already done that. You're supposed to have sent the contributions by today. So when I talk to you like that, I'm not talking about employers. I'm talking to all of us, because most of us are employers. If you have at least one employee, that is what the act says, then you are an employer and you should have registered with Nssf and you should have made those contributions by today. However, I know there are very many challenges with this. Employers have their concerns, the big employers, the ones who have many employees to deal with. But most of us also who will be contributing to this fund, we have our own concerns. There's a lot of mistrust with Nssf because of the past scandals that we've heard about. The current members, most of us are current members of Nssf, but we don't seem to know what goes on there. We rarely get our statements. We rarely attend the annual general meetings. We don't even know that such things exist. So we are already not in touch with one, and we are wondering, now we're increasing our contribution and we're just going to put more money into things that we don't understand. And I believe there's something we can do about that. But what I would like to say is that there's a lot of information available, especially in the Nssf websites. They put all their audited accounts there. You can actually learn a lot about Nssf from there. So a lot has changed. Previously, Nssf used to manage most of the funds. Nowadays, they manage a very small proportion of the funds. They have professional fund managers. Some of the leading fund managers in the country are managing the pension funds. They offer some decent returns. Their returns are not bad. and they're working very hard to manage their expenses to try and lower them. The Act actually gives some limits, and as we progress, we're actually going to see that. So it is understandable why people would be concerned about this new Act, but let us look at what the Act talks about. So the Act talks about the old Nssf, and basically it talks about closing that fund and replacing it with two funds, and it will replace it with a pension fund and a provident fund. So the previous fund was a provident fund. Provident fund means when you retire, you can access all your savings as a lump sum. But now it's replacing that fund mainly with a pension fund, whereby you can't access all your retirement savings as a lump sum. Mainly you should receive it as an income. But there's also a provident fund, which will basically be for the self-employed. The other thing it talks about is to define membership. And I think I've talked about if you have at least one employee and there is an implied or an express contract that this person works for you and you pay them for their service, that is enough. You don't have to have a written contract. So many of us are basically employers. It talks about the contribution rates and how they're going to progress. It introduces what it calls earning limits, the upper limit and the lower limits, tier 1 and tier 2 contributions, and also the whole issue of contracting out. So we'll go through all this and we will see how we can comply with this Act. So the spirit of the Act, in my opinion, is very good, because basically what it's trying to do is to ensure that everyone who is working, whether you are employed or self-employed, you'll have some basic social security. You'll have some savings that you can actually use in retirement. Currently, there are only a few employers, actually only less than 20% of people in employment or people who are gainfully engaged. Let me not talk about employment, even people in business. Only about less than 20% are actively saving towards their retirement. So through retirement benefit schemes. So they could be saving through other means. Some people say their children are their retirement plan. I don't know how solid that one is. Some people invest in land and other assets, but a specific tool for retirement, which would be now a retirement benefit scheme, only about 20% or less. Of course, a large number are saved through the Nssf, but majority of these are just the people in formal employment, who are about 20% of the working population. So basically, majority of people do not have retirement savings. And we see that as people retire, and we see people going into old age poverty and dependency. So basic of social security is one of the things that it intends to provide for everyone. 2, it wants to increase coverage so that it's not just a few employers who can afford this, but it is basically everyone. Every person who is working should have access to this, to saving for retirement, whether through the employer or even through their own voluntary membership. Of course, the other thing it's doing is to increase adequacy of benefits. So for a very long time, for those who are close to my age or older, we contributed 80 shillings per month, and the employer contributed a similar amount. And later we moved to 200. And that has not been much, especially when people retire. So, for example, I have a client who retired recently, and her total Nssf fund was 400,000. Having worked is hardly enough to sustain you through retirement. So by increasing the improving the benefits so that the benefits can be meaningful and provide you with an income in retirement. Of course, they're introducing what they're calling out the contracting out option. So basically what this is helping us with is that if we don't trust Nssf, majority of people do not, then they're giving you an option to actually save for retirement, but through private pension providers. So there's a basic minimum that will go to Nssf, but actually the bulk of your savings can be invested by a private scheme, and we will see how you can do that. And of course, to help with the implementation, they have staggered the contributions. You're not contributing 6% of your employee salary. It is starting at a lower level, and it will keep on increasing until probably at one point it will be gross. I don't know if we'll get there, but the government has given that progression. So let's talk about the old Nssf before we move to the new Nssf. So I've said the old Nssf was a provident fund. When you retire, you go and collect all your money and you decide what you want to do with it. The management of the old Nssf are the same ones who are going to manage the new Nssf. So both the board of trustees and even the employees, they are all going to transition into the new fund. They are going to continue managing the old fund, but they're going to close it to any new contributions or membership, except for arrears. So if you are an employer who are not remitted arrears, you'll still remit arrears up to January to the previous fund, but it will not accept contributions for the new fund, for the new season. The assets are going to be ring-fenced, meaning that they are going to be protected and they are going to be used for the purposes of members. So when it's time for you to access your benefits, you'll go to Nssf. They are the same organization, but they will pay your old benefits from the old fund and new benefits from the other fund. And the assets of the old fund will not be transferred to the new Nssf. The members in the old fund will be transferred automatically to the new Nssf, but your benefits will not be moved. So at the point of retirement, let's say 20 years from now, some people will actually have multiple benefits to access. You will have the old Nssf, you'll have the new Nssf, and you'll probably have some benefits from a private scheme. So that means the two funds will not mix, but the old fund will meet its obligation as and when they come out. So that remains, and I believe they'll continue giving us statements for that fund, even as we move on to the new fund. Now, the new Nssf, there are two funds, like we mentioned, and I think for purposes of today's webinar, because of the content, I'll focus on the pension fund, because that is the mandatory fund. Actually, when you look at the provident fund, which is for the self-employed, it is very similar to the old fund in terms of minimum contributions and even the benefits, and almost everything sort of remains the same. But the new Nssf, the pension fund, is very different from the provident fund. So the pension fund, basically where if you have an employee, you'll need to register them, and most of us are employees, will be registered into that fund. The main responsibility is pegged on the employer. This means the employer must register, and they must register their employees. They must make check-off deductions from employees, and then they add their own contributions and remit to Nssf. And the contribution rates have been stipulated. This is 6% of salary, excluding those variable incomes like allowances that probably are not fixed. Maybe if you have a certain emolument that is not fixed, it varies from month to month. For example, people in hotel industry, they earn a lot of tips from customers. So that will not form part of your minimum contribution. And of course, it will have tier 1 and tier 2 contributions. So the difference here is that this will be a pension scheme. A pension scheme does not allow you to access all your savings as a lump sum. You can access up to a third, and the balance, you have to access it in form of an income. The only exception that is given is when probably once the pension is calculated, it is trivial. It is very, very small. And I think it's, if I'm not wrong, it's 50% of the minimum wage. That's when now you are allowed to take the lump sum. But with the new kind of contributions that people are making, especially those who will be in the scheme for quite a while, many people will definitely have an income that is above trivial pension. So the key thing to look at is that the responsibilities on the employer, and of course, it is a pension scheme, like what civil servants have. They get an income for life. That is the kind of benefits that you will actually expect. So let's talk about the contributions. The contributions are pegged at 6%, but for the first year of implementation, that has been, there's a maximum that you can contribute. So they put a minimum, what they are calling the lower earning limits as 6,000. So it doesn't mean that if somebody is earning less than 6,000, they won't join this fund. It doesn't matter what somebody earns. If you're paying somebody 4,000 shillings, you need to register them into the scheme and you need to contribute 6% of their income into Nssf, the tier 1. So the maximum that can go into tier 1 is a maximum of 6% of whatever income you have up to 6,000 per month. And that puts a limit of 360 shillings per person. So some people will actually contribute less. If you earn 5,000, that will probably be 300 shillings. That will be from the employee and a similar amount from the employer. But for tier 1 purposes, the maximum that is calculated on tier 1 is on 6,000 shillings. Now, I will demonstrate this a little bit later, just to show if you're earning 5,000, if you're earning 20,000, if you're earning 100,000, or if you're earning 500,000, what is the implication? So there's that tier 1 which must go to Nssf. So it is whatever 6% of your income is up to a maximum of 360 shillings per person from the employee and a matching amount from the employer. So that is just an elevation of about 160 from what most of us were paying. We were paying 200 shillings and the employer was paying 200 shillings. And once the schemes are able to contract out of pension, out of Nssf, that is the maximum, if you wish, you can put to Nssf. You don't have to put more than that in Nssf for the first year. Then, of course, there's an upper limit. So it means even if your salary is way higher than 18,000 for the first year of implementation, the maximum salary they're using for computation is it's 18,000 a month. And that now gives a maximum of 720 shillings from an employee and a similar amount from the employer. So the tier 2 contributions are starting low, but they will keep on increasing as I will demonstrate. And they'll probably grow to huge numbers as time goes by. But the tier 2 contributions, again, you have an option of not contributing that money to Nssf, but taking it to a private scheme. However, there are regulations that need to be implemented. The schemes need to contract out. And for majority of people, for the next few months, they'll have to put both tier 1 and tier 2 in Nssf until their schemes comply with the regulations and they're able to, you're able to put your money now into those schemes. So as an employer, what should you do? As an employer, once you register with Nssf, you need to ensure that you're doing the calculations correctly, you're deducting your employees' contributions, and you're also putting your own funds. Now, the one thing the Act has made very clear is that you cannot force the employee to make employer contributions. The employer contributions must come from the employer resources. So as you're planning your salaries for your employees, as you're planning to recruit, you need to incorporate this cost as part your, overall compensation to that employee. So just like you budget for office space, you budget for tools, you budget for laptops or computers, for tea, then that is basically what we're supposed to do. We are supposed to add this other expense. And as we said, it will be increasing from year to year. So if as an employer, you do not want to put tier 2 contributions, or even as an employee, or you are you're saving voluntarily for your savings, then you need to join a scheme that has contracted out. So the contracting out is a process that will allow schemes to be allowed to receive tier 2 contributions. So as an employer, you'll need to write to RBA, Retirement Benefits Authority, and apply to contract out. But before you do that, you need to decide which scheme are you contracting out to. So if, for example, you are an employer who already has a retirement benefit scheme, your scheme is with ICA, Old Mutual, Sanlam, wherever it is, you can actually pick that scheme to be where you put your tier 2 contributions. However, that scheme first has to be approved to access, to receive the tier 2 contributions. And they have to pass what is being called a reference test. And this reference test, they will get that approval either from an actuary or from their scheme administrator. Basically, scheme administrators are the people who maintain your records. Some schemes do their own administration. Some schemes have external administrators. So they need to get that passed before now you can use their certificate to actually apply to RBA. So it is important to note that most people will have to contribute tier 2 contributions to Nssf for a while, because the schemes have a process to go through for them to give you the certificate. And then once you have the certificate as an employer, then you can apply to RBA. And RBA requires that you do that 60 days before you want to contract out, and then they respond within 30 days. So it will be quite a process. That is the part of employer, and I'm really emphasizing on employer because most of us are employers, because we have drivers, we have house managers, we have people who take care of other businesses that we do. So is it a good thing to contract out? I would say it is really a good thing to contract out if you do not want to put your money with Nssf. And I think that was a very good provision that they made, sort of deal with trust issues that we have with Nssf. And it's good to actually compare and look at what are the kind of returns that Nssf is giving and what are the kind of returns that you can actually get from private schemes out there. And then once you have them, then you can decide whether you want to retain your contributions with Nssf or you want to contract out. And I believe there will be that ability to switch. You can be in Nssf for a while and decide to switch out. And if you want to go back to Nssf, I believe that they should not have a problem receiving that. So let me project just to demonstrate what I've talked about, especially when it comes to the contributions, just so that we have a mental picture of this. I know many of us have already seen those deductions in our salaries, in our pay slips, but it would be good to just see how, if you have not done it already, what needs to be done. So allow me a minute to just share this. Yes, so this is just an illustration of the progression of earnings. And again, this is a good thing that the government did. They didn't force employers to pay 6% of full salaries. They decided to introduce it in a progression way, starting from a low amount and then increase with time. So as I mentioned, in the first year, the lower limit is 6,000. And I mentioned if your employee earns less than 6,000, you still calculate 6% of their earnings. But the upper limit is 18,000, which is basically 50% of the national average earnings. Now, this is a figure the government gives. And one of the implications that will happen is that every year we would expect them to confirm these figures. So they could go up, they could be lower, but every year they should give us and confirm this is the national average earnings. And then in the second year, then you'll need to calculate 6% up to the national earnings, which is 70,000. When you go to year 3, it is estimated that the national average earnings will be 77,000. So the contributions will be up to a maximum of 6% of 154,000. So for employees whose salaries are below the upper earnings limit, of course, you'll use their salary to calculate the total contributions. For those who earn above the upper earnings limit, it means that for what is over and above the upper earning limit, you will not be contributing in terms of the Nssf Act. But if you're in a private scheme, you can always continue contributing that. So I think many people, when they see maths or they see tables, they switch off. I would encourage people to just first focus on the first year. If you're an employer, then probably you can engage a pension consultant. You can talk to me. I can help you even to plan in the future. But for now, just for simplicity and to be able to understand what will happen in the first year, I would encourage you to first of all forget what happens in the other year. The minute you understand the first year, then you'll be able to apply it in the second year. So the first year of implementation, I just want to tabulate this in terms of what I said. Somebody is earning less than 6,000. Let's say you have someone who is earning 5,000. You'll calculate 6% of their salary, which will be 300 shillings, and that is below the lower earning limit. That means they will contribute the actual 6% of their earnings. If their salary is 6,000 or above 6,000, then the tier 1 contribution will be based on 6,000, not on their salary. And so for somebody who is earning 6,000, that will be exactly what the minimum is, 360. If you're earning 100,000, tier 1 will only be 6% of 6,000. So this lower earning limit is set by the government, and we'll expect them to confirm this every year. Now, that is what will go to tier 1 contribution, but there's also a tier 2 contribution, and this is basically what the employee contributes. The employer will be matching exactly what the employee does. So for tier 2 contribution, then you'll be calculating it as 6% of the difference between somebody's salary, if it is below the upper earning limit, and the lower earning limit. So for this person, their salary is below 6,000, so they actually will not have any tier 2 contributions, including somebody who is earning 6,000 shillings, because that is the limit for the lower earning limit. But for someone whose salary is 20,000, tier 2 will not be the difference between 20,000 and 6,000, but the government has set the upper earning limit of 18,000 for year 1. So you'll just calculate 18,000 for all your employees minus the lower earning limit, and then everyone will be contributing 720. So for all those people who earn above 18,000, their tier 2 contribution will be identical. The amounts will only vary for those people who earn between 6,000 and 18,000. But this is the maximum. So in the first year, the amount an employee will pay is 1080, and the employer will pay a matching amount. And so the total amount will be whatever amount minimum to 2160. Now, a number of employers way back in 2013 actually implemented this, and when the act was suspended, they didn't stop making this contribution. So we have quite a significant number of employers who are already doing this. So for them this year, there's not going to be any change. But I know majority of the people who listen here normally have private pension scheme, and I just want to demonstrate what that means when you're in a private pension scheme. So we'll use the same data, and we'll actually assume that your private scheme has a contribution rate of 5%, not even 6%. Does it mean as an employer, you must increase the contribution to 6% so that you comply with the law? It does not necessarily mean that. You can actually amend your scheme rules so that you'll continue giving 5% and also ensure that you comply with the Nssf Act. So for people who are earning lower amounts, their 5% might be below the Nssf minimum requirement. So for example, 6% of somebody earning 5,000 would be 300, but because your retirement benefit scheme has a contribution rate of 5%, then it means their 5% of their salary would be 250. In that case, then you must pay the minimum, which is prescribed by Nssf Act. But for the other employees, their 5% will, for example, if you're earning 20,000, your 5% will actually be 3,160. And so 1,000 shillings can actually go to a private scheme. So what we are going to see is that maybe in this year, some employers will have to adjust contribution rates for some employees, but going forward, they might have to reconsider the contribution rates, but they do not necessarily have to increase the contribution rate for everyone at the same time. Of course, RBA normally talks about you should not discriminate against certain categories of employee, but I believe depending on how you word your contribution rate, you can actually comply with this. So if you're contributing 5% and all your employees are earning above 6,000, you will be good to go. But if you're contributing, if your employee salaries are higher, you will be good to go. But if your employee salaries are lower, then you might have to make these adjustments. So what this means is that you will continue contributing, you'll make tier 1 contributions, tier 2 contributions, and you'll have excess contributions which can go to your private scheme. Now, this also gives employers who probably have been considering to set up a private pension scheme, it's an opportunity to actually do so if you've been planning to do that, or you need to include it in your plan so that with time you can be able to effect it. And so, yeah, this will bring some administrative issues, but basically with time you'll get the hang of it, and you'll just need to make one contribution to Nssf, probably tier 2 contribution and excess contribution to your private scheme. But we'll see later that for some schemes, it will actually bring a complexity, especially the big schemes who probably run provident funds. Then we'll get to that and see what are some of the implications. So in a nutshell, it is important to note that everyone who is earning above 6,000 and probably up to 18,000, the maximum you can contribute this year is 1080, and your employer contributes 1080. If your pension contributions are way above that limit, then those will continue going to the private scheme. I hope that is clear. Now, let me talk about the implications. I want to dwell more on the implications than on governance issues, and I also want to give time for people to ask questions. So one of the implications that implementation of this act is going to have is that every person will have some retirement savings. Any person who is above 18 years and who is employed will definitely have some retirement savings when they retire. But if you're in self-employment, you have an option of doing that. And there is a fund, the Provident Fund, that has been set up to enable you to do that. So I would say there is no excuse why we should not do that. We should actually ensure that we save. It will not be surprising to see some entrepreneurs setting up these benefits for their employees and leaving themselves out. And I hope you will not do that if you're an entrepreneur. As you enroll your employees, please also ensure that you either join the pension scheme or you actually join the Provident Fund. So again, as I mentioned, we expect probably during the budget for the Minister CS for Treasury to actually give these limits, the upper earning limits and the lower earning limits, probably confirm what is already we are working with, or probably give different amounts. So we'll be keen to observe and see whether that has been changed. Many people are thinking the pension industry, the current private schemes are going to suffer, but they might have a temporary dip in contributions in the next few months. But actually what I expect is that the industry will actually grow, because I would expect a significant number of employers to choose to put the tier 2 contributions in private schemes as opposed to Nssf. That means there will be many more people who will be saving through private schemes than they were doing before. And that is a good thing. One of the things that will happen is that the domestic savings will increase, because these contributions, when they are saved with pension providers, they are availed in the capital markets, where people can now invest in businesses, they can buy shares in companies, they can fund private companies, the government can borrow from the pension schemes, and probably reduce some of the borrowing they make from international markets. And that probably will be good for us as an economy. So more savings into the economy definitely should work better, because there's more capital for people to do business. And when business do well, again, there's more income for people, they can save more, and that gets into a compounding effect. I know that the current government is very keen on that, on using savings from retirement funds to go into low-cost housing. As pension schemes, you're allowed to use up to 30% of your funds to go into property. So that would be a source of funding for such projects. But at individual and scheme levels, what are some of the implications? Some people will choose to continue making tier 2 contributions to Nssf. Some people will contract out. All pension providers, and here we are talking about schemes, organizations that provide like individual retirement funds, will definitely have to work on their schemes to ensure that they get the referenced scheme test certificates from an actuary or from the administrator. So that is a process that should be happening. And once they have that, then they'll use that to apply to RBA. So as an employer who is probably looking for a scheme to put your tier 2 contributions, you will need to request that reference scheme certificate from that fund. So some providers, I don't want to name names, but many of the providers, for example, of individual retirement funds, actually operate provident funds. So let me just mention, I do some business with Kenindia. I have some clients who are in Kenindia. That is a provident fund. They might have to consider setting up a pension scheme, or rather they will have to consider that if they are to access tier 2 contributions. So they might have now to add another scheme. Some clients who run provident funds, and there are many, because many of the current schemes are voluntary schemes, they will have to choose to either set up their own scheme, which is a pension, while maintaining the provident fund, or they might choose to convert their provident fund into a pension scheme. So there is some realignment that will need to happen for those who already have schemes to decide whether to retain the scheme or to maybe join another. Sorry about that. I seem to have been kicked out of my own meeting. Sorry about that. I have changed the network. Hopefully we will be able to go through. So I was talking about employers who have retirement benefit schemes, especially provident fund, and I know there are many. They might need to make those decisions. So what I see is that some employers will need to consult with retirement consultants or the administrators to actually work these things out. So you might experience some delays with your employers, especially when they have to make these decisions. So they might actually choose to put the tier 2 contributions directly to Nssf for the time being as they sort out these things. The other thing is that at the point of accessing your benefits, especially now for those who will stay for a while, this will introduce some complexity. So I don't know if you've ever heard about US, when you probably read about retirement industry in US, you hear people have 401k, they have social security, they have employer's pension, and you're wondering, why do they have so many pensions? That's where we are headed. So we will have old Nssf, we'll have tier 1 pension, we'll have tier 2 pension, and we'll have excess contributions if our employers chose to give us those benefits. So that will bring some complexity, and probably many people will need professional help. So I'm foreseeing that we'll be doing good business in a few years as people have to make decisions regarding all this. So for now, I'd want to stop there before and take any questions that might be there. The last thing I'll want to address is the benefits. What are the kind of benefits that you will access from Nssf, the new Nssf? But before I discuss that, I would want to find out if we have any questions. There's one comment from Michael Mwangi. He's saying, Provident Fund, pension funds, these are tongue twisters. Anyone who feels like it's a tongue twister? If Michael feels, I want to believe that there are probably other people who feel the same. So let me slow down and just explain the difference. Let's start with a Provident Fund. A Provident Fund is a retirement benefit scheme that allows you to access your retirement savings on retirement as a lump sum. Now, let's use practical examples. The old Nssf is a Provident Fund. When you reach retirement age, you go to Nssf, they calculate for you, they tell you this is the amount you have saved. They work it out. For most people, there's no tax that is payable because the benefits have been low. They pay you your money and you go with your money, you go decide what you want to do. That is a Provident Fund. Now, you might feel a little bit confused, especially if you're a member of a scheme, the schemes that have been existing, employer schemes, because probably when you left employment, you accessed your money as a lump sum. Part of your money as a lump sum, and maybe there's a portion that was left. That is not to mean that your scheme is necessarily a Provident Fund. It's just that there's some withdrawal benefits that you're allowed to access. But if you wait until retirement age, which for many schemes will be either 55 or 60, or you access your retirement savings at the early retirement age of 50, if you're in a Provident Fund, they will calculate your money, they will deduct any taxes applicable. You take your money. If you want to go and buy a matatu, that's what you will do. If you want to go put up apartments, that's what you'll do. If you want to go and invest in bonds, you will actually go and do that. That's a Provident Fund. And that is what the old Nssf has been. Now, a pension scheme does not allow you to access all your money as a lump sum, but it allows you to access for some schemes, and let me use probably the government scheme. Most of the civil servants who are members, who are pensionable, that is an example of like a pension scheme. It's just that it's not a scheme in the sense that it doesn't have its own assets. The government pays out of the revenue it collects on an annual basis, though they have changed that. Now there is a civil service scheme. But the typical retirees we know, when they left, when they retired, they received only a portion of their pension as a lump sum. And I think it is 25%. Then it was 25%. But the 75% was accessed over the rest of their life. So if somebody retires at 60, they live to 70 to 80 to 100, they continue receiving a pension from the government. And that's exactly what now the new Nssf will be. You will save your money there, but you cannot access all of it as a lump sum. You can only access part of it as a lump sum, but the balance really has to be accessed in form of an income. And probably you ask yourself, why are they making this change? Because most people, when they access lump sums, they don't manage them well. Or even if they manage them, they don't last them a lifetime. They probably use them, start businesses that probably succeed, some don't succeed. And many people end up now going into old age poverty or dependency. So when it's a retirement benefit scheme that is a pension fund, I remember talking to one administrator who told me she's an administrator in a parastatal scheme. And she told me some people earn a very small pension of about 2,000 to 5,000 shillings per month. But those people enjoy a certain level or quality of life that those without that income do not have. Because that income is guaranteed for as long as they live, they know they will get that income every month for the rest of their lives. And that enables them to go to the nearest kiosk and take some things on credit. They can go see a doctor or buy medicine on credit, and they're credit worthy because at the end of the month, even if the amount they receive is small, they're able to actually go and pay. So I believe that is the whole rationale of converting the old Nssf from Provident to the pension scheme. So we are moving away from Provident schemes. We are now moving into the pension scheme. So going forward, if you're in the new Nssf, you will access the new savings as an income, but the old one, you will still access it as a lump sum. I hope it's no longer a tongue twister. I can see Dr. Wanini asking, kindly clarify on what are these tiers. Is there a tier 4? No, there is no tier 4. So the Nssf Act defines tier 1 and tier 2. That everyone will have to contribute as long as your salary is, if you're going to have a salary of above 6,000, you will definitely have tier 2 contributions. So you'll have tier 1 and tier 2. What I would call tier 3, but it's really not, it's not described as such in the Act, is for those people who choose to contribute over and above the minimum requirements of the Nssf Act. So for example, you had already decided that you'd be saving 20,000 shillings per month. 360 will go to tier 1 this year, 720 will go to tier 2, the balance now will go to what I'm calling excess contributions. If you want, you can call that tier 3, but there is no tier 4. But strictly speaking, the Nssf only prescribes tier 1 and tier 2, and then you can have that other category of benefits. Victor is asking, how will someone register their employees, especially in the informal sector, such as drivers, house managers? You need to do that with Nssf. I believe you can give them a call. I believe probably there's some information on the website. And if you don't get help, you can just walk to their offices and ask them for that. Part of what the Act talks about is providing regulations around all these changes. So some things might take a while to really enforce, but I believe if you want to register your employee today, if you're not able to get that information from the website, if you visit their offices, they will definitely be able to do that. But even currently, as new organizations are set up, they normally register with Nssf, and I believe there's some application form in the website. I believe I must have seen it at one point. Rachel Kimuyu, you're saying, what about voluntary contributions? I don't know exactly what you mean by that. Maybe you can expound. But if probably you're asking whether you can make voluntary contributions to Nssf, definitely you can do that. They have prescribed the minimum, but if you want to save more with Nssf, you can always do that. You can choose to put your money in Nssf. There are people who contribute 5% of their salary. There are people who contribute 7% of their salary into the current Nssf. And I believe even with the new Nssf, you can actually do that. What you must comply with is the minimum, but the maximum, they'll be happy to take your contributions and invest them for you. Steve Kipkoti is asking, how does someone obtain report statements for their old Nssf account? You just need to request for your statements. There's some people who try to access them online and they are able to, but some people are not able to. But when I'm dealing with my clients, especially the ones who are retiring, I just encourage them to go to the offices, Nssf offices and they actually get their statement. Actually, one of the feedback they give me is that they're actually very, very surprised because the kind of service they expected is quite low, but they actually get a very good service. So they're able to get their statements. Sometimes you'll find your statement has gaps. You might need to go back to your form of employer so that they provide evidence that they made those contributions. And even for those who access their benefits, they are able to pay your benefits in good time. Most of my clients have actually been impressed by their service. So if it's too much, I mean, if you can't get information on the website, just visit their offices, they will assist you. Hannah Kinyanjui, what is the impact of this new act on those people who are already retired and are still operating a provident fund account? That's a very good question, Hannah. So the old provident fund, as I said, has been closed. Unless you have arrears, you can't put money in there. And I know today I have not focused much on the new provident fund, but the new provident fund will allow anyone to join. It's a voluntary scheme. Actually, you can choose to join the Nssf and the provident fund if you so wish. If you are once an employee, you retired and you're still, actively engaged in, you're generating an income and you want to continue saving for retirement, you can actually join the provident fund. So the provident fund is a voluntary scheme and anyone can join over and above being a member of the Nssf. If you retire, you can also go and join the provident fund. What happens if there are gaps with your employer and the employer closed operations in the country? Wow, now that's a tricky one. I don't know if the employers left any records. If you have your pay slips, I think that would be the easiest thing to do. You just need to take your pay slips to Nssf and probably now have a discussion with them to find out what would happen if your organization closed offices. But normally, organizations have requirements to maintain records for up to 7 years. So even if they have closed, they must maintain those records somewhere. And probably their lawyers or maybe another organization will be able to handle that. But I would say, take your pay slips to Nssf and find out what will happen from there. Now, I would want to just talk a little bit about the benefits that you will be entitled from the Provident Fund so that we get to see once you save your money, what do you expect? Is it worth it? Is it not worth it? And there are mainly 5 categories of benefits that you can get from the new Nssf pension fund. So the first one, of course, is the retirement benefit. And this will be a retirement pension, a retirement income. So once you're 50 or above, you can retire from age 50. That is considered the early retirement age with approval of your employer. If you probably were retrenched or you left employment earlier, once you reach age 50, you can actually go for your benefits. If you're still in employment, then you have to wait until you leave your organization. And at that point, then you will go to Nssf. Probably you only had your tier 1 contributions with them. That must buy a pension. If they were managing your tier 1 and tier 2 contributions, you can actually access a third of your tier 2 contributions as a lump sum, but the 2/3 of tier 2 plus the tier 1 contributions combined will actually have to buy what you call an annuity. You can use tier 2 contributions. You can get a pension or an income from tier 1 contribution, but you can also choose to use your tier 2 contributions to buy what you call an income drawdown. So what does this mean? It means that the new act is introducing flexibility. There are many people who don't like buying an annuity because they normally feel like all their money is tied up and there's no way they can get that money, because you buy an annuity from an insurance company. You take your lump sum to them and they promise to pay you an income for the rest of your life. And of course, subject to certain minimum guaranteed years. We have discussed this in previous webinars where I talked about annuities. but the tier 2 contribution, now you have an option of whether to buy an annuity or actually to buy an income drawdown. Again, an income drawdown is a product that gives you an income in retirement, but unlike an annuity, you take the savings, you transfer them to a provider, and the provider invests them on your behalf, and you can draw an income from those savings for a minimum of 10 years. But you can structure it to last even longer than that. So for those who want a combination of both, now you can actually have an annuity and an income drawdown from your tier 1 and tier 2 contributions. Of course, if you have excess contributions, you can choose to combine all of them and now make these choices. But it is important to note that tier 1 contributions cannot buy an income drawdown. It has to buy an income from an insurance company of your choice. So at that point, again, you will shop around in the market. You can contact us. We can help you shop around in the market and identify a provider for you. So the new arrangement will provide that flexibility, which is a good thing. So in case you don't live to retirement age, or you don't have to work until then, in case you suffer from permanent and total incapacitation, which could be physical or mental, and this needs to be certified by a doctor who is certified by the medical board, then you can actually earn, there are two ways. If you have contributed for less than 36 months, then you can be given your accumulated savings and you can actually get it as a lump sum. So you suffer an incapacitation that is permanent, will not enable you to continue working in the same environment or even to generate an income. If you've only saved for 35 or less months, you can actually get it as a lump sum. However, if you have saved for more than 36 months or more, you have to get a pension. And the way they are calculating the pension is they look at the last tier 1 contribution that you made, and they increase that by the number of months between your age and when you would have retired, or a maximum of 90 months. So what this means is that the last tier 1 contribution you will be making is what will be used as the basis for your pension. So I don't want to go into a lot of maths at this point, but it's important to know if you contribute for, if you retire on medical grounds, we call that invalidity pension. If you have not saved for more than 36 months, you'll get a lump sum. If you have saved for more than 36 months, then you'll actually get an income, which will be based on your last tier 1 contribution, and then they will apply a factor. Now, suppose you die before retirement age, then there will be a survivor's pension. Again, if you had saved for less than 36 months, your beneficiaries will receive a lump sum. But if you had saved for more than 36 months, they will apply the same formula like the invalidity pension. So your dependents will actually receive an income as opposed to a lump sum. And this income will come from Nssf itself, not from a private provider. If you choose to relocate from Kenya, you immigrate from Kenya with no intention of coming back, then you can actually access your savings as a lump sum. However, if you're moving to Uganda, you're moving to Tanzania, you're moving to the East Africa community, Kenya has reciprocal arrangements with those countries, so that will not apply. But if you're going to US, you're going to UK, or you're going to Egypt, anywhere outside where they have reciprocal arrangements, then you can actually access your benefits. So basically this puts very similar to what we have with private schemes. The main addition is how they are calculating the invalidity pension and also how they are calculating the survivor's pension, which I think is a good thing because sometimes what you need is an income as opposed to a lump sum. That income might actually help. So to take care of those who've not saved for long, they give a lump sum because the pension would really be a small amount. And for those who have saved for a little bit longer, they will actually have an income. And they have introduced a funeral benefits. So if you're a member of the new Nssf and in event of your untimely death, they will pay a small amount of 10,000 to your next of kin or the people who are managing your funeral arrangements. And you need to claim that within 60 days. Your family needs to claim that within 60 days for it to be processed. But you must have been a member of the new Nssf for a minimum of 6 months. So these are good benefits, in my opinion. They're geared towards ensuring that you have that income in retirement. And in event of your invalidity or untimely death, your beneficiaries also have an income, as opposed to necessarily having a lump sum, which many people are sometimes not able to manage well. So I think what I'll do, I will break this down in short newsletters so that you digest them. Small bites as opposed to the whole thing. So in the coming weeks, I will try to write just a short newsletter on one aspect of the Nssf Act. Hopefully within the next 2 or 3 weeks, we should be able to have covered everything so that you can process that. But if you asked me, yes, it's a good thing. Ultimately, it will be for our good. Majority of the people who currently do not have savings for retirement, which is a very significant part of our population, they have an avenue through which they can actually do that. If you don't want to put all your money with Nssf, they have given you an opportunity to actually do that with a private scheme, which is a good thing. And you have options in the market. There are very many pension funds. I know it will be difficult for employers to implement this initially, but I would encourage you as an employer. I normally say we manage God's resources, not our resources. And probably instead of being so worried about where will this money come, I think we should be praying to God to actually provide these resources so that we are able to provide for our employees. They're giving us the best years of their life when they're energetic, and when they're unable to work, then it should be okay for us to actually give them something to rely on. And since we can't wait until when they retire, then this is an easier way of actually preparing for their retirement. So in a nutshell, that is my view. I know there's a lot of debate out there, but I believe that many of the concerns people have, the Act has actually put steps in place to address them, especially the mistrust of Nssf. And also for employers, they will not get this cost in full in the first year, but they'll have time to actually plan for it as the contributions progress. So I think I would want to stop there. And I would want to check if there is questions or comments. If you have a question, feel free to ask before we wind up. Damaris Kanana is saying, thank you for good presentation. Kindly send me the recording. We hope to share the recording. I know there was that interruption. I hope that won't affect the recording. For those who had registered, they will definitely share it. So if there's no question, at the moment, I would encourage you to share any question that you have through the same email that we sent the invitation to this webinar. I will endeavor to answer as many questions as possible. If you are an employer and you need guidance on this, I consult on that. I can help you to work around all this to even identify potential schemes that you can put your tier 2 contributions. Part of that, I'll probably not charge you for it if depending on the kind of consultation you want. If you just want to identify a provider, I will normally not do that at a cost. I will do that free of charge, but the company I will introduce you to will pay me a commission for introducing business to them. So please do not struggle. If you want an objective, independent opinion, you might not want to work with maybe somebody who is tied to an organization. You can come to us and we'll objectively look at the opportunities in the market, and then you'll get to choose what you want to do. So I look forward to receiving your questions, and I look forward also to sharing this same information in form of newsletters, and to address these issues in a manner probably you'll be able to digest much better. So if there's no more questions, I would want us to end. And again, allow me just to say a word of prayer. Thank you, Father, for the opportunity you've given us to go through these Nssf acts. We know that it's a new thing, and as human beings, we tend to resist change. We tend to fear the unknown. But Lord, we want to thank you that this is one of the things that may help us, or may help our employees or other people in our community who probably are not preparing for retirement in any formal way. So we pray that, Lord, you'll give wisdom to those people who are in charge of managing these resources, providing the necessary regulation, and enabling employers to join and contract out of the scheme. We pray that, Lord, you'll give people insights on how they can actually achieve this noble objective. We pray that Nssf will manage these resources well, and when we need them in our old age, that they will be able to provide for us. But we continue to put our trust in you. We'll make the plans, but we know that, Lord, you're the one who provides for all our needs, and you have promised to be with us even in old age. You'll never leave us, and you'll never forsake us. So even as we make these plans, we know that our provision will come from you. So we entrust ourselves into your mighty care, even as we plan to comply with these regulations, because you've asked us to obey the authorities that we are under. And we want to pray this, trusting and believing in Jesus' name. Amen. Have a good evening.
And you too.
Thank
Thank
you.
you.
Thank you, Rose. You too.
Good evening.
Thank you.